Today, I am excited to present a cash flow of Apple Inc., focusing on its recent trends from 2023 to 2025. Specifically, we will look at how efficiently Apple manages its assets through depreciation costs, and how it deploys its massive cash flow for shareholder returns. Let's talk about depreciation and amortization of Apple. The figures over the 3-year period remain remarkably consistent, hovering tightly between $11.4 billion and $11.7 billion. A stable D&A expense implies that Apple is maintaining a steady, continuous rhythm of reinvestment into its tangible assets and intangible assets to replace aging infrastructure. Depreciation and amortization are core non-cash fixed costs. The high predictability of these expenses reduces financial volatility, allowing for more stable forecasting of operating income and cash flows. It serves as a sign of a highly mature and financially healthy business model. Then, we get closer into D&A to gross profit ratio. The D&A to gross profit ratio decreased from 0.077% in 2023 to 0.066% in 2024 and 2025, holding steady thereafter. As noted in the previous analysis, Apple's absolute D&A dollar amount remained highly stable at around $11.5 billion. Maintaining a very low D&A to gross profit ratio of 6% to 7% highlights Apple's exceptional ability to generate high-margin revenue relative to its fixed asset investments. Therefore, the decline in this ratio indicates that the denominator, Apple's gross profit, grew at a faster pace than its depreciation expenses. Despite being a hardware manufacturer, this metric reflects a highly efficient, high-yielding business model akin to that of a software company. Now, we focus into how much money Apple repurchases its common stock. Apple spends an astronomical amount of cash buying back its own stock every year. Spending between $83 billion and $95.6 billion annually on share repurchases ranks at the absolute top globally, proving the company's unparalleled capacity for cash generation. The repurchase volume increased by about 3.3% from 2023 to peak at $95.6 billion in 2024. However, in 2025, it declined by roughly 13.2% year-over-year to $83 billion. This shift implies that Apple may have moderated its buyback pace in 2025. Possibly reallocating capital toward dividend increases or capital expenditures (CapEx) for future growth drivers like artificial intelligence infrastructure. By repurchasing and retiring common stock, Apple reduces its total outstanding shares in the market, which organically boosts earnings per share EPS even if net income remains constant. The sustained high volume shown in this chart demonstrates Apple's active commitment to enhancing shareholder value and providing strong baseline support for its stock price. Last, we talk about dividends of Apple. The widening negative bars indicate that the total cash amount allocated for dividend payments has steadily increased every year. The payout grew from roughly $14.47 billion in 2023, successfully surpassing the $15 billion mark by 2025. Compared to Apple's massive stock buybacks, which range from $83 billion to $95.6 billion annually, the dividend payout of $14.5 billion to $15 billion is relatively modest. This demonstrates that while Apple heavily favors tax-efficient share repurchases as its primary method of capital return, it concurrently maintains a stable dividend growth policy, raising its dividend per share year after year. Distributing $15 billion annually solely in dividends underscores the incredible cash-generating power of Apple's ecosystem. A consistently rising dividend payout serves as a strong signal to the market that management remains highly confident in the company's long-term profitability and financial stability. Net profit ratio (ROA) is calculated by dividing net profit by total assets. By multiplying by 100, you can calculate the net profit generated by the company over a certain period of time. While keeping its annual D&A expenses steady at around $11.5 billion, its rising gross profit successfully lowered the fixed cost burden to a mere 6 to 7%. Most notably, Apple executed massive net common stock repurchases ranging from $83 billion to $95.6 billion annually, shrinking total outstanding shares to aggressively drive EPS growth. Concurrently, it consistently raised its total dividend payouts from $14.4 billion to over $15 billion. This highlights a world-class capital allocation strategy that masterfully pairs buyback-centric tax efficiency with steady dividend growth.